Assalamualaikum warahmatullahi wabarakatuh. We are from Group 5. Today we will discuss about transfer pricing and tax complication case. I will explain question number 1. It is, should Michael report newfound information and cooperate with the European Commission or just remain silent? Okay, based on our opinion, Michael should report the newfound information about Outfell and should cooperate with the European Commission. The reason is because Michael has found out that the company has misused the transfer pricing strategy in the company. Even though this method is legal in the first place, however, Outfell has used this measure to the extreme in order to increase company profit and pay tax at a low rate. Okay, if Michael stays silent on this issue, Outfell will continue to make profit in the future and take advantage of income tax opportunities. Since Michael's role is to prevent Outfell from adding to existing summons, his presence is also important for Outfell business to avoid company from making mistakes that could have negative consequences in the future. Okay, after that, Michael found the issue, Michael talked to Scott regarding these issues. Okay, however, Scott said that Michael doesn't need to worry about this matter and doesn't need to reveal it to the public. Michael also realized if the company doesn't take precaution now, it will have a big impact on the future company. In addition, Michael should also make Outfell company pay tax at the proper rate. This is because Outfell currently pay tax at a very low rate of 0.005%. This tax rate is very low compared to what other company pays. However, the Irish government just keep quiet. However, Outfell has to pay at 12.5% as other company. If Michael chooses to remain silent, the company will bear a great risk in the future. As a result, the company had to be investigated by the European Commission for tax evasion due to abuse of the transfer pricing method. Second question in question 1 is, does the Irish tax authority know the preferential treatment that Outfell received? Okay, based on this case, Outfell has received preferential treatment by the Irish government. This is because the Irish government has given permission to Outfell corporate tax rate to be reduced from 1% in 2003 to 0.005% in 2014. From this tax reduction, it can be concluded that Outfell pay a lower tax rate than the original tax rate that should be paid like others company, which is amount 12.5%. But legally, the European Commission considered this to be illegal or wrong in under Irish law because it allow Outfell to pay less tax rate than other firms, and it should be investigated by the authority. Okay, second issue, they can see Outfell being receive preferential treatment is Outfell can decide and can determine whether to taxable profit of two Irish incorporate businesses, that namely Outfell Sales International and Outfell Operation Europe, in such a way that all sales profit are recorded internally and attributed to the head office. Therefore, these two companies will be seen as not responding to economic changes and will be able to reduce the tax rate payable. Additionally, this agreement with Ireland is currently considered as state aid by the Irish government. And the final question in question 1 is ethical dilemma faced by Michael in related issue. Okay, the ethical dilemma faced by the Michael is that he is not sure whether to report the issue excessive transfer pricing and the preferential treatment fell received by the European Commission or just remain silent because he doesn't want company to bear the burden of lawsuit.
Hi sir, my name is Kelinjil Mokyong. So for question 2, should AFIL change its operation or organizational structure? So based on AFIL case, the Director of Finance of AFIL has found that AFIL might face the transfer pricing regulation risk for tax avoidance. Michael found that AFIL had been paying a very low rate of income tax, which is 0.005%, huge different with Ireland, which was 12.5%. So AFIL, which located in high tax jurisdiction, can transfer the price of their income and expenses to shift their income to a low tax to decrease income tax rate. So all this transaction is to reduce tax evasion. In our opinion, AFIL should restructure its operation of the company by paying their tax. AFIL shall paying their rate at 12.5% to the Irish government. Besides that, AFIL also claimed to be a tax resident of Bermuda, a tax haven country, to make a higher profit. So transfer pricing can lead to the tax saving for corporation through tax authorities may contest their claim. The next issue we want to discuss is how can AFIL avoid such transfer pricing issues from arising in the near future. So first, AFIL are required to do detailed documentation. AFIL must prepare the documentation for their annual transfer pricing, for example, their intercompany agreement with their subsidiaries. These are the important material that are required to cover the intercompany transactions, especially the company's recurring transaction wherever it is applicable. Hence, there will be no doubt arise on the issue of which policy are in effect. Besides that, AFIL also must ensure the related invoice for intercompany transaction on a regular basis. For example, clear description on the invoices. By that, AFIL may save more time if they prepare the documentation by covering multiple countries. Next, AFIL also shall always be prepared for an audit. AFIL shall prepare all the necessary documents on hand in advance. They also shall prepare or provide the audit communities with an experienced advisor on call to aid the investigation with a true defense to back up them. It is important to bear in mind that the lesser time those auditors spend obtaining accurate answer means the lesser they might. Besides that, AFIL also assess their company policy regularly, especially when they finish in restructuring their organization. AFIL is required to evaluate its transfer pricing document on an annual basis and compare it to the requirement of each authority in the business operate. To make things easier, AFIL shall involve a single policy only during this process, with minor changes made as needed for AFIL to fulfill the local requirements. Last but not least, AFIL shall be proficient in calculating the arm's length, as it is critical aspect in AFIL's transactions. Based on AFIL cases, AFIL is controlled by its parent company in the US, the United States. AFIL Sales International and AFIL Operation Europe, which are the subsidiaries, sold similar product in the same time frame. However, the organization's sales operation in Europe was set in a method that customers were contractually buying Ireland's product rather than the physical shop itself. This uncontrolled transaction must meet high comparability standard for it to be considered as a comparable price. Moreover, it is important for a company to be proficient in the particular principle applied on the organization.
Okay, so now let's discuss the third question, which is Michael is planning to enhance the corporate governance of Apple so that Apple can reduce the risk when it comes to the issue of transfer pricing. And how should he propose this? And how can he overcome the ethical dilemmas faced? And what are the alternatives that he can use to convince Scott? So first, we will discuss on how can Michael propose the plan to enhance the corporate governance of Apple. So the first thing that he can do is clear transfer pricing policies, which is recommend the development and implementation of comprehensive transfer pricing policies at Apple. So these policies can serve as a foundational document, outline the specific methodologies, documentation requirements, and compliance procedures. So clear and well-defined policies are essential to provide guidance to stakeholders involved in transfer pricing decisions, ultimately reducing the risk of non-compliance. So the second one is governance committee establishment. So Michael can propose the establishment of a dedicated governance committee or the empowerment of an existing board committee. This is to oversee the transfer pricing practices. This committee would play an important role in regularly reviewing and approving transfer pricing policies. Its oversight function ensures that these policies will align with the company's strategic objective and that there is ongoing compliance with evolving regulatory standards. And the third one is he need to propose for regular audits and assessment. So this suggestion is to implement a periodic internal transfer pricing audit program. So regular audits will help to identify potential risks and then know the areas for improvement and ensure ongoing compliance of transfer pricings. And then this proactive approach is instrumental in addressing issues before they escalate, contributing to the continuous improvement or enhancement of transfer pricing strategies and to minimize the risk of non-compliance. And the fourth one is he can propose for ethics training and communication. So he can advocate for the development and implementation of comprehensive ethics training programs tailored for transfer pricing considerations. This is because communication efforts should emphasize Apple's commitment to integrity, compliance, and the potential consequences of unethical behavior. So, a well-informed and ethically conscious workforce is pivotal for fostering a culture of ethical decision-making within the organization. And the fifth one is he can propose for external expert involvement. He can recommend to engage external experts or consultants with transfer pricing expertise to conduct independent reviews of Apple's transfer pricing practice. So, external validation not only enhances the credibility of the company's governance efforts, but it also provides an unbiased perspective of the effectiveness of current strategies, and it helps to identify areas for improvement. And the last one is stakeholder engagement, which is Michael can propose for active engagement with key stakeholders, including investors, regulatory bodies, and other relevant parties. So they can transparently communicate Apple's commitment to ethical transfer pricing practices and positioning the company as a responsible corporate entity. So proactive stakeholder engagement not only build trust, but they also reduce the likelihood of external scrutiny. The next issue that we need to discuss in this question is how can Michael overcome the ethical dilemmas faced and what are the alternatives that he can use to convince Scott. So the first alternative that he can use is to reiterate the concerns clearly. So maybe Michael can schedule a meeting with the higher ups and the board to reiterate his concerns. So he can clearly and concisely communicate the ethical implications and potential risks that will associated with the current transfer pricing practices, and then he can use the documented evidence to prove his points. And then next, he can also collaborate with experts, or like collaborate with external experts or consultants specializing in transfer pricing on corporate governance. And then he can also engage professionals with expertise in the field that can provide an independent perspective that may carry weight in the board and the higher management. And then he can also engage with the shareholders. So if appropriate, engage with key shareholders or investors who may have an interest in Apfel's ethical business practices. Shareholders often have this is because like shareholders have like influence, and their concerns can prompt the board to reconsider decisions, and that may pose like reputational or financial risks. And the fourth one is Michael can consider external reporting channels. So if internal efforts prove unsuccessful, and then Michael believes that the issues are like of significant public interest, he may consider reporting through external channels such as regulatory authorities or whistleblower programs, which is in accordance with applicable laws and also regulations. And this is the ways how can he convince Scott. So maybe he can align with the business objective in terms of giving his plan. So Michael need to emphasize how improved corporate governance aligns with Apfel's broader business objective, including long-term financial sustainability, compliance with international regulation, and positive stakeholder relationships. So he need to showcase the benefits for Apfel as a whole that can resonate with Scott. And then the second ways is he need to present like a phased approach. So instead of proposing an immediate overhaul, so he can suggest like a phased approach to implement the governance enhancements, and then a gradual implementation can make the changes like more manageable and allow for adjustment based on feedback and results. And then he can highlight legal and regulatory compliance. So he needs to stress the importance of legal regulatory compliance in the realm of transfer pricing. So he needs to emphasize how enhanced governance will position Apfels to adapt efficiently to regulatory changes, and then it can reduce the risk of legal implications and foster a like more positive relationship with tax authorities. And the fourth one, he need to use like a persuasive communication. This is like he need to craft like a persuasive and compelling message that speak to Scott's concern and interest. So he need to use clear and concise language backed by data, examples to make the case for enhanced corporate governance in a way that resonates with Scott's.
Hi, Assalamualaikum. My name is Nur Sabrina, and I will answer question number 4, which is Michael is facing the risk where he could be convicted as well if Apfel is found guilty. He might lose his job due to his failures to alert the related parties. So the question is, what can he propose to Apfel to do next? So in his role as finance director, Michael plays a crucial role in maintaining Apfel's financial well-being and also ensuring compliance. He identifies potential risks such as aggressive tax planning and also suggests proactive measures to address them. Michael focuses on maintaining ethical and also legal standards, aligning with industry norms, and also demonstrating responsible business conduct through his leadership. So here are his proposed actions for Apfel's next steps. Step number 1 is Michael should propose strengthening at first corporate governance policies to prevent aggressive tax planning, because it addresses the ethical dilemma associated with the company's legal but also questionable tax practices. Robust corporate governance ensure transparency, accountability, and also ethical behavior within the organization. By enhancing these policies, APFL can establish clear guidelines and also check to prevent excessive use of transfer pricing for tax optimization. Strengthening corporate governance sends a message that APFL is committed to responsible business conduct, ethical financial practices, and also compliance with international standards. It helps build trust among stakeholders, including employees, customers, and also regulatory authorities, and contribute to the long-term sustainability and also credibility of the company. Point number 2 is internal audit and also compliance checks. By implementing regular internal audits and compliance checks within APFL's financial framework is crucial for monitoring and enforcing adherence to transfer pricing policies. By systematically reviewing intercompany transactions and also related documentation, these audits serve as a proactive mechanism to prevent aggressive tax planning. The process involves assessing whether transfer prices align with the arm's length principle, ensuring they mimic transactions between unrelated entities. Through this stringent scrutiny, APFL can identify and also rectify any deviation from established policies, mitigating the risk of legal and also ethical issues related to transfer pricing. These checks not only contribute to maintaining compliance with tax regulations, but also foster a culture of transparency and also accountability within the organization, aligning financial practices with both legal standards and ethical considerations. Okay, point number 3 is conduct internal review. In urging for APFL to undergo a comprehensive internal review of its transfer pricing practices, Michael is emphasizing the critical importance of ensuring ethical integrity and also legal compliance within the company's financial operations. The proposed examination would involve a meticulous analysis to verify APFL's adherence to both ethical standards and also legal obligations governing transfer pricing. And furthermore, Michael's recommendation to adopt transparent and also equitable transfer pricing methodologies aligns with international guidelines, seeking to establish a framework that promotes fairness and openness. By scrutinizing internal transactions, this approach aims to guarantee not only a level playing field, but also ethical conduct, reinforcing APFL's commitment to compliance with established legal norms in the intricate domain of transfer pricing. Ultimately, this proactive stance reflects a dedication to responsible corporate governance and also integrity in financial practices. Okay, next question. Are there any changes that can be made that are within Michael's jurisdiction and also powers as a Director of Finance? As the Director of Finance, Michael does have certain powers and responsibilities that can be exercised within his jurisdiction to address the issues related to transfer pricing and also the potential ethical dilemma. Here are some changes that Michael can consider within his role. Number 1, Michael might suggest structural changes for APFL's IRIS operations to decrease dependency on transfer pricing for tax optimization. This could entail relocating manufacturing or intellectual property functions to Ireland or other jurisdictions with favorable tax regimes. So by strategically redistributing operational aspects, Apple can potentially minimize the need for aggressive transfer pricing, fostering more sustainable and also ethically sound approach to taxation. This proposal aims to align the company's operations with tax regulations while maintaining financial efficiency. Okay, point number 2 is proposal for organizational changes. To align Apple with ethical tech practices and regulatory compliance, a proposed organizational change involves establishing a dedicated tax compliance department headed by a chief ethics officer. This department will collaborate closely with finance, legal, and operational teams, fostering a holistic approach to tech practices. The Chief Ethics Officer will oversee the organization's adherence to ethical standards and regulatory requirements and implementing regular ethics training for all employees. The introduction of an ethics hotline ensures a confidential channel for reporting concerns related to tech practices and fostering transparency. Updating organizational policies to explicitly include ethical tech practices, emphasizing the positive societal impacts of tax contributions through strengthened corporate social responsibility initiative, and also implementing regular reporting to the board will collectively establish a culture of responsible tax compliance within Apples.
I'm Adlina and I will continue present on other points of changes that Michael can consider within his role and limitation that he faces. Changes that Michael can consider is on internal controls and policies. To foster ethical financial practices, Outfell needs to enhance its existing financial policies, explicitly addressing transfer pricing practices. The goal is to develop guidelines that align with both legal requirements and ethical standards. This involves a comprehensive review and update of policies to reflect the complexities of international tax laws. Implementing stringent approval processes for intercompany transactions, especially those involving subsidiaries in tax jurisdictions with preferential treatment, is imperative. This ensures that all transactions comply with ethical boundaries and legal requirements. Next is documentation and transparency. Proper documentation of transfer pricing methodologies and transaction is crucial. Outfell should establish robust standards to ensure clarity in the rationale behind transfer pricing decisions. This includes documentation of the value created at different stages of the supply chain and the justifications for intercompany prices. Such documentation not only facilitates compliance but also serves as a defense in case of regulatory scrutiny. Promoting transparency within the finance department is vital. Regularly sharing information on transfer pricing methodologies and practices foster an environment of openness and ensure that all team members are well informed. This internal transparency helps in building a cohesive team and operates within ethical boundaries. Transparency should extend beyond the organizations. Outfront should make information on transfer pricing practices available to external stakeholders, including shareholders, regulatory bodies, and the general public. This commitment to external transparency builds trust, enhances the company's reputations, and showcases Outfront's dedication to ethical financial practices. The next is what are the limitations that he faces. While Michael McMonaghan, as the Director of Finance at Outfell, has the authority to initiate certain actions to address transfer pricing issues, he also faces several limitations in navigating the complexities of the situation. So these limitations include limited authority beyond finance. Michael's realm of expertise resides in the financial domain, and his role primarily revolves around fiscal matters. However, the intricacies of transfer pricing demand collaboration with departments beyond finance, including legal operations and executive leaderships. Decisions regarding organizations of operations adjustment often extend beyond his immediate jurisdictions. The success of proposed changes hinges on the cooperation of cross-functional teams, adding layers of complexity to the resolutions process. To address these limitations, Michael should proactively establish cross-functional task forces fostering collaboration between finance, legal, and operations teams. Workshops or training sessions could be conducted to enhance the understanding of transfer pricing complexities across different departments. Next is dependency on board approval. The authority to draft substantial changes, especially those related to ethical guidelines or organizational modifications, is contingent on board approval. Gaining support for alterations that may impact the company's financial performance and competitive position is a multifaceted process influenced by factors such as financial impact, legal implications, and alignment with strategic goals. Constructing persuasive and well-documented proposal becomes imperative for Michael. These proposals should highlight the ethical and financial implications of the proposed changes. Additionally, regular and transparent communication with the board is crucial to ensure a thorough understanding of the necessity and benefits of the proposed alterations. And the next is lack of operational control. While Michael can propose changes to organizational structures, their executions and management involve operational aspects beyond his direct control. Collaboration with the Director of Operations and relevant departments is indispensable for effective executions, ensuring alignment with operational realities. To overcome these limitations, Michael should establish strong communication channels with operational counterparts, ensuring a holistic understanding of proposed changes. Involving operational stakeholders in decision-making process can enhance the efficiency and effectiveness of the proposed changes. And the last one is external scrutiny and reputational risk. Taking actions that attract external scrutiny, such as reporting retrospective tax assessments, introduce potential reputational risks. Michael must carefully navigate the consequences on upfront image, customer perceptions, and stakeholder relationships, balancing legal and ethical considerations with potential reputational fallout. Thorough risk assessment before reporting retrospective tax assessment are essentials. Michael should consider potential reputational risks and devise communication strategies to transparently convey the ethical motivations behind actions, mitigating potential reputational damage. By understanding and proactively addressing these limitations, Michael can steer upfront towards ethical and sustainable resolutions in the intricate realm of transfer pricing. This success of his initiatives will not only impact Upfeld's financial well-being, but also shape its reputations and standing in the global business landscape.